Imagine this. Every time you swipe your card, pay a bill, or check your bank account, you're not just spending your money. You're re-participating in a system designed centuries ago by a small group of powerful men who understood one profound truth: whoever controls the creation and flow of money controls everything else. Society, governments, wars, booms, and busts. But here's the chilling part. Most people believe their earnings are truly theirs, hard-won through work and saved in secure banks. What if I told you that the very dollars in your pocket were engineered, not by your government alone, but by hidden architects operating behind closed doors? Architects who meet in secret, pull invisible levers, and profit immensely while the rest of us chase an illusion of financial freedom. Today, we're pulling back the curtain on these hidden architects, the elite bankers, families, and institutions that shaped modern money. We'll trace how they turned debt into a weapon, fractional reserves into endless creation, and central banks into tools of quiet domination. This isn't just history. It's the hidden code running your life right now. Stay with me, because by the end, you'll see the world of money in a way that might keep you up at night, and empower you to question everything. To understand who truly controls your dollars, we have to go back, way back, to when money was real, backed by gold or silver, tangible, limited. But even then, clever minds saw opportunity in scarcity. The story begins in Europe, with the birth of modern banking. Goldsmiths in the 17th century discovered something revolutionary. People deposited gold for safekeeping, receiving receipts, early banknotes, but not everyone withdrew at once. So, goldsmiths started lending out more receipts than gold they held. Fractional reserve banking was born. Keep a fraction, lend the rest, charge interest, profit from nothing. This simple trick exploded wealth but planted seeds of instability. Banks could create money out of thin air, but if too many depositors demanded their gold, panic runs, collapse. Enter the first central banks, not to protect you but to protect the system, and those who built it. The Bank of England, founded in 1694, was the blueprint. Proposed by Scottish merchant William Paterson, it wasn't a public institution at first. It was private. Investors loaned £1.2 million to the government to fund war against France, in exchange for a charter to issue notes and manage debt. Key figures like Charles Montague steered it through Parliament. Suddenly, a private bank had monopoly power over England's money. Tease this. Was it for the public good, or to enrich a select few? History shows the latter: endless wars funded by debt, profits flowing to shareholders. Fast forward to the 19th century. Banking families like the Rothschilds rose, coordinating across Europe. Meyer Amschel Rothschild sent sons to key cities: Frankfurt, London, Paris, Vienna, Naples. They financed governments, profited from wars famously. Nathan Rothschild's early knowledge of Waterloo's outcome, their influence on central banks, immense, though often exaggerated in conspiracies. They didn't own them outright, but lent to nations, shaped policies. The twist: central banks evolved from tools of war finance to controllers of economies, always with private interests woven in. Now, America resisted. Thomas Jefferson warned, banking institutions are more dangerous than standing armies. The First Bank, 1791, and Second Bank, 1816 of the U.S.C., inspired by Alexander Hamilton's admiration for the Bank of England, were controversial hybrids. Part public, part private. Andrew Jackson killed the second in 1836, calling it a hydra of corruption. For decades, no central bank. Panics raged. 1873, 1893, 1907. In 1907, J.P. Morgan personally bailed out banks, one man acting as lender of last resort. This set the stage for the big twist. The creation of the Federal Reserve in 1913, promised as a solution to panics, decentralized, public serving. But was it? Whispers of secrecy surround its birth. We'll dive deep, chronological, cause and effect, revealing how a secretive meeting changed everything. Our story's origins lie in the need for war, finance, and economic control. The Bank of England, 1694, wasn't born from benevolence. England was broke after wars. Paterson's plan: private subscribers fund, government debt, get interest, issue notes, private profit from public money. It worked brilliantly for the elite. The bank managed national debt, issued fiat-like notes, funded empire building, influence, profound. It set the gold standard model, spread worldwide. In America, Hamilton pushed the First Bank, 1791, to stabilize post-revolution finances, modeled on England. 20% government-owned, rest private. It issued currency, managed debt. But Jeffersonians saw it as elitist, favoring merchants over farmers. Charter expired 1811. War of 1812, chaos, led to Second Bank, 1816. Bigger, more powerful. Nicholas Biddle ran it masterfully, but arrogantly. Jackson vetoed renewal in 1832, paying off national debt, only time in history, dispersing funds to state pet banks. Free banking era, states chartered banks, wildcat notes, fraud rampant. Panics followed. 1837, land speculation bubble. 1857, railroads. 1873, overextension. No lender of last resort. Clearinghouses pooled resources temporarily, but instability grew. Enter the architects. Powerful bankers like J.P. Morgan, House of Morgan, Rockefeller Linked, National Citibank, Kuhn, Loeb, and Co. They dominated finance, resented competition from smaller banks, because recurring panics threatened the system. Effect: calls for reform. National Monetary Commission, 1908, led by Senator Nelson Aldrich, tied to Rockefellers via marriage. Aldrich toured Europe, admired centralized models, but public hated money trust. Aldrich plan, private central bank, banker, teased the twist. Public opposition forced secrecy. The real plan hatched not in Congress, but on a private island. November 1910. 6 men board a private train from New Jersey, under aliases destination, Jekyll Island, Georgia. Exclusive club owned by Morgan and Friends. No press, no records. For 9 days, they draft a banking revolution. Who were they? Nelson Aldrich, Paul Vorburg-Kuhn, Loeb partner, European banking expert, Frank Vanderlip, National City Rockefeller, Henry Davison, J.P. Morgan, Charles Norton, First National Morgan, a POT Andrew Treasury assistant, representing perhaps 1/4 of world's wealth. Their plan: central bank with 12 regional branches, private stock owned by member banks, but public oversight, elastic currency via fractional reserves, lender of last resort. Aldrich plan, introduced 1911, but Democrats won 1912. Woodrow Wilson, president, promised reform without Wall Street dominance. Twist: the plan survived, rebranded. Carter Glass and Robert Owen crafted Federal Reserve Act. Compromise: board appointed by president, but regional banks private. Signed, December 23, 1913, suspiciously, just before Christmas recess. Cause panic of 1907 showed need for stability. Secret meeting allowed bankers to design system protecting their interests. Effect: Fed created as decentralized central bank. Member banks own stock, in reserve banks non-tradable, fixed dividend, board public. But who really pulls strings? Class A directors, bankers elected by banks. Influence subtle, profound. Warburg later admitted uniform discount rates settled at Jekyll. Vanderlip as furtive as any conspirator. The hidden architects won a system blending public facade with private power. The Fed promised no more panics. Early years helped WWI finance, but 1920s, boom, loose money, stock bubble. 1929 crash. Fed's response: tightened credit. Great Depression ensued. Friedman Schwartz, Fed's mistakes turned recession into catastrophe. 1930s reforms. Glass-Steagall separated commercial investment banking, FDIC, insured deposits. But fractional reserves amplified booms, busts. Post-World War II Bretton Woods, dollar-gold-backed Fed key player. 1971, Nixon shock ended convertibility. Fiat era begins. Money unanchored. 1970s, stagflation. Volcker 197987, hiked rates, brutally, recession, but tamed inflation. Breaking points: 1987 crash, Fed liquidity, 2000 dot-com easy money post Y2K, 2008 crisis, subprime bubble, fueled by low rates post 2001, Fed, under Greenspan, kept rates low, Greenspan put, housing mania, when burst, near collapse, cause central bank policies, low rates, moral hazard bailouts expected. Effect: massive fallout. Lehman fell, AIG, bailed. Key: Fed balance sheet, from $900 billion to $9 trillion, money printing, unprecedented. Hidden influence: BIS Bank for international settlements. 1930 Central Bank for central banks, Basel, Switzerland. Hosts meetings, set standards, Basel Accords. Owned by member central banks, but immune from taxes, laws. Tower of Basel, quiet power coordinating global policy. Fallout profound. Global debt exploded. 2025, over $300 trillion total. Public tilde, $100 trillion plus. U.S. debt, $35 trillion plus. Interest payments rival defense spending. Fractional reserves plus central banks equals endless money creation. Banks lend multiples of deposits. Fed sets reserves now zero. Controls via interest on reserves. Patterns repeat. Boom, easy money. Bust, tighten, or bubble pops. Bailout QE. Low rates. Wealth transfers up. Asset owners benefit from inflation. Debtors, governments devalue obligations. Modern parallels, shocking. Post-2008 QE inflated stocks. Housing. Rich got richer. COVID, trillions printed. Inflation surged 2021-23. Fed hiked rates, pain for borrowers. Data, global debt, GDP, approximately 235% plus. Developing nations, net outflows, servicing greater than inflows. Who benefits? Architects, descendants, big banks, asset managers, BlackRock, Vanguard, own stakes everywhere. Advise Fed, repeating, every crisis strengthens central banks. More power, less accountability. Reforms promised fixes. Glass-Steagall repeal, 1999. Bigger banks, riskier. Dodd-Frank, 2010. Stress tests, but TBTF, Bigger Basel III, higher capital, but loopholes. Failed. No return to gold. No end to fractional reserves. Independence. Fed audits resisted. Crypto, Bitcoin tease real alternative, but co-opted. Fixes entrench. Crises justify more control. Connecting to modern parallels. Today, your dollar controlled by Fed decisions. Rates set by FOMC, unelected. Money supply. Influenced, not directly controlled, banks decide lending. Shocking data. Top 1% wealth, sword post-crises. Middle class debt-laden. Patterns. Low rates gives bubbles, gives crash, gives QE, gives inequality. 2025. Debt unsustainable. Burst looming. 3 clear takeaways. Money isn't neutral, created via debt. Benefits creators lenders first. Central banks, born in secrecy, prioritize system stability over individuals, often inflating away savings. Fractional reserves amplify everything. Gains and booms, pain and busts. Warning, open-ended thought, the hidden architects built a masterful system, resilient, profitable, self-perpetuating, but cracks show unsustainable debt, eroding trust. What if the next crisis shatters the illusion? Will we demand real reform, or hand more power away? If this opened your eyes, like, subscribe, comment your thoughts. Who really controls your money? Share with someone trapped in the system. Next video, how to protect wealth when fiat fails. Stay curious. Knowledge is your first defense.